Very good afternoon. Myself Dr. Ruchi Gupta. Today we will discuss a topic financial statements. So, basically a financial statement, it describe the financial situation of any company. So, we after creating the final statement, we can easily evaluate, we can easily identify the actual financial condition of any company, that the company is in loss or it is in profit situation. So, we have to evaluate the financial condition of any company by the with the help of various financial statements. So, these are some financial statements which we have generated. One is the balance sheet, second is the income statement, next the cash flow statement, the final is the fund flow statement. So, basically these are the statements through which we can once we have to generate these statements, then we can easily evaluate the financial situation of the company, and we can easily identify that the company is running in the good situation or it is in the bad situation. So, we after that we have to improve in the various criteria, and after that we can again next in the compare the financial statement the next years. So, the two financial statement, it measure one aspect of performance of the business over a period of time. So, we have just evaluate the balance sheet, cash flow statement and fund flow statement. So, one is a cash flow statement. It signifies the changes in the cash and cash equivalent of the business. So, in the cash flow statement, we have just evaluate the financial situation of the company on the basis of the cash only. So, some cash is to be debit and some cash is being credit in the company. So, we have just check all the credit and debit cash amount of the company, and we can evaluate the performance of the company over a period of time. And second one is the fund flow statement. Fund flow statement, it reports changes in the business working capital from its operation and in a single period of time. So, in the fund flow statement, we have just calculate the overall working capital of the company on the basis of the asset and the liability of the company. So, first of all, we have discussed about the balance sheet. So, what is a balance sheet? Basically, a balance sheet, it is a performer that is to be generated by the company. It is, we can say, it is an account statement in which we have to represent the asset and liabilities of the company. So, one term is the asset and another term is the liability. Asset means what are the how many investment of the company in a single financial years, and liability means how many expenses we done by the company in a single financial year. So, the projected balance sheet, it referred to as a, it is a performer balance sheet. We have just create the performer, we have just create the account statement of the company, and it show the estimation of the total number of asset and the total number of liabilities of any business. So, as I have already told you that the total number of asset means total number of investment of the company in a single financial year, and the total number of liability means total number of expenses of the company in a single financial year. So, asset is divided into two category, one is a current asset and another one is a fixed asset. Similarly, the liability is also divided into two category, one is the current liability and second one is a long term liability. So, if we are talking about the current asset, so current asset basically it defines the investment, current investment of the company. Suppose we have kept some amount in our account. Suppose if we are having a 10 lakh amount credit in our account, so it is our current asset, because we have just we just have a cash of 10 lakh in our account, it is a current asset. And if we are talking about the fixed asset, so fixed assets are the those assets they have if we are having a some long term investment, like if we have to invest in the property, in the building or furnitures or fixtures, these are our long term investment. Similarly, we have some liability. current liabilities are those liabilities, suppose that we have just give some amount to another company or another part. So suppose if we are having a 10 lakh amount in our account, and we have just debt 5 lakh amount from our account. So 5 lakh is the debt money, and it is our current liability. And similarly, if we have just paid the loan amount regularly, this is also our come in our current liability. So the balance sheet is to be evaluated on the basis of the total number of investment and total number of liabilities of the company. So the this performer balance sheet, it is a tabulation of the future projection. So on the basis of creating this performer, we can also evaluate the future future projection of our company, that it will be in the loss or in a profit situation in the future also. So as a result, it will help the business manage your asset and now for better results in the future. So once we have to prepare or generate this balance sheet, we can easily identify that our investments are high or our liabilities are high, our expenses are high. So if our expenses are high as compared to our asset, so we can manage, we can reduce our expenses, and we may increase our investments, so that we can make a balance between asset and liability, and we can easily manage our business. So the asset, it will contain, as I already discussed, that assets, it may be a current asset or a long term asset. So asset, it may contain a long term asset, that is a non current asset, and the second category is a current asset. So these long term assets are the investment in which we have to invest our amount into a long term basis. Like if we are having if we have to just purchase some property of 1 crore, this is our long term investment. If we have to just invest some money into our furnitures and fixtures of the company, this is our long term investment. And if we are talking about the current asset, so suppose if we are having some amount in our account, this is our current asset, and we can use immediately our current asset. So long term asset, it will include the building, land, machinery and vehicles. So if we have to just purchase the building, if we are having land, if we are having machinery, furniture, fixtures, vehicle, if we have to invest the money into these things, so it comes into the category of long term investment. Whereas the current asset, it includes the cash in our hand or in the bank. As I have already told you that if we are having some cash in our account, or if we are having some cash in hand, so this is our current asset, because we have to use this cash immediately as per requirement. So if we have to receive some cash and stock for the short term, so this is our current asset. So we have just identified that how many current asset and how many things are in the long term asset. Similarly, we are having liabilities also. We will also calculate the liability also in the balance sheet. So the liability means we have some non current or current liability. Similarly, for the asset, we have just liabilities. So liabilities are also defined, described or divided into two parts. One is the current and another one is a long term liability. So if we are talking about the non current liability or the long term liabilities, so suppose the term loan and the current liability includes the account payable and short term loans such as working capital loan. So if we are having some loans on a short term basis, suppose if we are having some loan on for a single year only, and we have just repay the amount of loan, so this is our current liability. And if we have a long term loan, suppose if we are having a 25-year loan and we have just repay the amount year by year, so this is our long term liability. So you may need to prepare a projection balance sheet if you have applied for the balance loan for your new project, or you are interested to buy the new fixed asset. So we can manage our liabilities or our expenses which we have to expense for the various things. For example, if we have to pay salary to our employees, this is also our liability. So by showing well-crafted projected balance sheet, the bank will get the confidence that the business until it's worthwhile to invest and provide the loan. So bank is also consider this balance sheet once we have apply the loan for the bank. Then first of all, the bank is also check or evaluate the balance sheet of the company, that how many assets are there and how many liabilities are there. So after verifying this balance sheet, the bank will provide the loan to the company. So the following steps will help to prepare the projected balance sheet. So these are various steps to preparing the balance sheet. Number one, the first step is calculate the cash in hand at the bank. So in the first step, we have to just check the cash in our hand. So if you have no booking record of your cash, you can show cash in hand after your cash balance in the business pocket. So you can show the you can show the cash in your pocket also. This is your asset part. So you can also check the available bank cash at the bank. If you are having some amount in your account, then this is also your current asset, and both will be your current asset. As I have already told you that cash in hand and cash in your account both are represented the current asset value. Now these are the current asset, cash in hand or cash in account. Now the second category is the fixed asset. So as I have already told you that if we are having land, if we are having furniture, fixtures, machinery, land, so these investment come into the category of long term investment or long term asset or fixed asset. So see, everything around in you, make the list of asset that benefits are you are taking more than 1 year. So means if you have invest some money into more than 1 year and for the long period of time, then it comes into the category of fixed asset. So check its price from the cash memo or past bills and to calculate the time of use. If you are used it for example, if I am using this up to 3 years, it will value for surely decrease due to depreciation. Now charges to 20% per year on every fixed asset up to the use period with any method of depreciation. So if you are having some asset, if you are having some asset for the long term as a long term asset, that there may be a chance of the depreciation of your asset. So now you will get the current cost of the fixed asset. You will calculate the value cost of the current asset as well as the fixed asset at this in the balance sheet pro forma. Now after calculating the value of current asset and the long term asset, now we have to calculate the value of financial instruments. So if you invest your money in shares, bonds or other financial instruments, so you have just write down the total number of purchase price, and if it is decreased, suppose if it is decreased, then it means you have to show the current price of the financial instrument. Now the next is calculate the business earning. You also calculate the business earning when you have to just create the pro forma of balance sheet. So if you have not made a profit and loss account, so there is a need of for making some profit and loss account for the company, because if you have not made this profit and loss account, so you can compare your expense and your income. So we have just compared the expenses of the company and total income of the company. So in your income, if the income is more than your expenses, it means you are in profit situation. If the income is less than your expenses, it means you are in the loss situation. So, it will your net profit value, income minus expenses, this is your net profit value, and income minus expenses, if the value will come into the negative, then it is your net loss value. So, that will transfer to the liability side of the balance sheet. So, you should only deduct the expenses benefit you have obtained in which you have to obtain in a single year. Now, we have to just calculate the business liability as the current value, current asset or fixed asset value. We have also calculate the liability values. So, in the liability you can add bank loans. We have just, if we have to just repayment the bank loans, secured loans and some other loans, and it will be added to the liability side of the projected balance sheet. So, we have just the repayment of all the loans, it just go on the liability side. Now, in the next step, calculate the business capital of the company. So, business capital, in the business capital you have to just calculate the subtract outstanding liabilities and total asset value, and that will also add the balance sheet in the liability side. So, this is the pro forma of any company, that is there is an example given here to create a pro forma of balance sheet of the company XYZ. So, for example, we have just, as we have already discussed that in the balance sheet we have just prepared the we have just calculated the total number of asset value and total number of liability value. So, in the upper side, in the left side of the balance sheet, we have just write the current asset and the fixed asset of the company, and then the right side of the balance sheet we have just put the value of current liabilities and the long term liabilities value. So, for example, here we have just put the value of the current asset. So, here the current asset is the cash. The value of this cash is $54, $367, account receivable $177, temporary investment. So, we have just note down all the current asset value in the first columns, and we have just add all these values. Similarly, we have to just put the all value of fixed asset like long term investment, building, plant and equipments, furnitures and fixtures. So, we have just put out all the values in the fixed asset part. Now, we come on the liability part. So, in the liability we have put all the liability, current liability values like account payable, short term loans, current portion of the long term loans, account payable. So, all the expenses, current expenses will come into this liability category. Now, again we have to put the value of long term liabilities, that is mortgage value, other long term liability value. Then we have just add all these values of liabilities, and after that we have put some shareholder equity values, like if we have to just purchase some shares of the company, then we have also put these values, capital stock and retained earning, and this is the total equity value, and now the total liability and equity value is this. So, as we have seen here, we have just put all the asset values and all the liabilities value in the balance sheet pro forma, and similarly we have to just compare the asset and liabilities value of each and every year. So, we can easily analyze that in the previous year what was the situation, financial condition of the company. We can easily make a projection, financial projection of the company. We can check the current year financial projection, evaluate the current year financial condition, and we also project the financial condition of the company in the future also. So, this is the first type of statement which is generated by the company to evaluate the financial situation of the company, that is balance sheet on the basis of total number of assets and total number of liabilities. Now, the second type of financial statement is the income statement. This is also one method, or it is also one performer to evaluate the financial condition of any company. So, what is a income statement? So, income statement, it shows the total number of profit and total number of loss in the future period. So, or we can say the next quarter or the next financial year. For instance, it uses the formal as a regular income statement, but in the future, it crunching the number for the past, it is also known as budgeted income statement. So, in the income statement, it is very important for making the plans for attractive investors. So, they can invest more money into the company, and so that our income statement of the company, it may increase. So, it has to be as accurate as possible, even though it's about event that happened yet. So, some strategies for making projection depend on the age of your business. So, the investors may only invest in your company if they have just checked or evaluate the financial statement of the financial condition of the company into the number of years. So, basically it depends on the age of your business. How many number of years you have to run your business successfully. After that, the investors will invest the money in your business. So, you are making some projection for the established business on the basis of the past sales and expenses that give you a guide to the future. So, if your company is a startup company, if you are an entrepreneur and you have just started the company, so but you have experience in the industry, so use that experience to make your projection. And if you don't have any experience about the business previously, or any business about any experience about the to make projection, so you can hire an accountant who does or exploit the market research for your startup. So, you may appoint any accountant, they have make a projection for your company. If the company is new and it is a good idea to make the projection for the next 3 years, and you have just make a projection for the next 3 years, then first year projection should include monthly budgeted income statement. After that, you will go quarterly or half-yearly or yearly basis. So, the income statements will be generated on the basis of sales, total number of sales of the company and total number of expenses of the company. So, sales and expenses, to begin making your projections, look at the sale of your total number of sale of your company in a single financial year, or in a single month, or in a 6-month basis, because you have just calculate on the basis of month, quarterly, half-yearly or yearly. So, how many customers do you expect over the projection period? How many units sold over a period of time? If you are providing some services, what prices you have changed, and project the cost of goods sold. So, these include some fixed costs such as leasing a vehicle, and vehicle costs such as marketing expenses. So, you do not have to break everything down in item by item. It is very critical to break all the items individually. So, single item of office supply is probably enough to without detailing price ream for printing paper, for example here. Now, drawing out the statement. So, if you are making a projection for the next quarter, then you have just start the business, projected sales income regularly, and then subtract the cost of good to get the gross margin value. As we have already told you that we have just subtract the total income minus expense value. Then we have after that we have getting the net profit value. So subtract other operating expenses into the net income value, and then subtract any interest payment. If you have to receive any interest payment in your account, then you will also subtract that interest value from the income total sales value. So using your knowledge for making this income statement performer, so use the projected income statement to decide whether your plans need changing. Is your projected sales income is too low or too high? Then you have to just find out a way to improve your sales, and by moving more units or increasing the unit price value. So if the projections show your business running in the red at first, that is not very surprising, because lots of business start operating at the loss. In most of the business, there may be a condition of loss, because the losses should not be so deep as shut you down. So you can improve your business. There, it doesn't mean that your business may be shut down. You may improve. You have just identify the causes, and then you can easily improve your business. So it's a good idea to draw up the projected balance sheet, so that you can much debt you will be carrying. So this is the performer of income statement of any company. So in the in this performer, we have just take 2-3 things. Number one is the revenue. Total number of revenue generated by the company in a single financial year, and it is the gross sale will come into this category, because it is not a profit part. First of all, we have just checked the total revenue generate of the company, and then we have just also add some cost of goods sold value. Then we have to subtract all the expenses from the sale value, and finally we get some value. This is called your net profit or net loss value. So this is your net, this is called your net income value, income value. So which is arise after subtracting the expenses value from the net sales value. So these are some values. For example, as we seen here, these are the net sale value, and these are the value of cost of goods sold, which we have sale in a financial year, like beginning inventory, total goods are available, cost of goods sold. Then we have to just put out all the expenses values, like how many expenses we done by the company, how much amount is to be done in the, for example, in the advertising, bad debit, commission, depreciation, furniture, fixtures, insurance, maintenance, office supplies, payroll, then software, how much amount you have to use, you have just expend how much amount. So we have just calculate all the expended amount. Then we have just, if there are some operating income losses, we have also put these value, and then we have just subtract this value. We get this is our net profit value. So we have just calculate the income statement of any company by calculating the by subtracting the expenses value from the net income sales value, and finally we get the net profit value of any company. So on the basis of this net profit value or net income value, you can say that you are in the good situation, or it is your company is in bad situation. Now the third type of category of financial statement is the fund flow statement. So what is a fund flow statement? It states that changes in the working capital of the business in relation to the operations in one time period. So basically, working capital of the company, it may be calculated on the basis of some current asset and current liabilities. So for example, current asset like cash in hand, it is the current asset. The amount which we have to receive in our account, it is a cash asset, it will come into the cash asset category. Now the inventory, it is also come into the current asset. Similarly, the current liability, some if we have to just pay some amount, this is come into the current liability. So fund flow, it is based on the working capital of the company, where we have just checked take the current asset and current liability value. We don't consider the fixed asset and fixed liability value in the fund flow statement. So net working capital, it is the total change in the business working capital that calculated as change in the current asset and the total in the current liability. So we can say that we have just subtract the value of current asset minus current liability, and we get the working capital of the company. For example, if the inventory of the business, it increased from 1,40,000 to 1,60,000, then this increase of 20,000, it is the increase in the working capital of the corresponding period and will be mentioned on the fund flow statement. It will show into the fund flow statement that how much amount, how much increment in the amount is in the company, but the same would be not be reflected in the cash flow. It would not reflected in the cash flow amount. So the fund flow statement, it uses 4 components and we have just shown them, while a cash flow statement only show the cash position of the business. So a cash flow statement, it is basically a statement that show the changes of the cash position of the firm period to period, from one period to another period, and it explains the inflow or outflow of the cash over a period of time. So we have different projection or the cash flow, like cash receipt, it is for selling goods and services. The revenue from the interest and dividends are also included here. The operational expenditures, this is come into the outflow category, although interest expenses fall under this section, but dividends are not included, and dividends are considered as a part of financial accounting terms. So basically these are important financial statements like balance sheet, fund flow statement, cash flow, which we have generated. This is cash flow generation. So we have just generate the fund flow statement, balance sheet of the company, and we can evaluate the financial situation of the company. So thank you very much.